Bring that ass back like a boom, 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 boom.
Happy Sunday, guys. This is Supernova, your with Boom Traders weekly market overview, November 13th, week number 45. And let's get it going. First, we have our disclaimer. Financial products, including but not limited to futures, options, securities, forex, crypto, etc., involve substantial risk of loss and are not suitable for everyone. Past results are not indicative of future performance, and the information found in this video does not constitute an investment advice or a solicitation to buy or short sell a financial instrument. This video is for educational and informational purposes only. And now the session overview, as usual, the models, market price action, internals, notes, sentiment, seasonality. And at the end, we do have a summary for you guys. So, first one's first, overall market model. We do have it on buy caution, although there should be a huge mark right here. And I'll explain when we look at the charts. And then I also go into some option positionings for next week into OPEX. So we do have it on buy caution, but I would stress on the word caution instead of the word buy. So don't go out buy everything that you can. This Monday, just listen to the presentation throughout the end, and you will see what I mean. Just be careful here. As far as the breakout model, I have it at not working. Now you might be wondering, well, what's going on here? Like the indices rallied like huge since the CPI numbers came, and so forth and so forth. Yep, that's true. But if you have noticed the performance from individual stocks, you will see that most of the stocks that actually did well, or stocks like DOCS, DOCS, you see that rallied like 32% on Friday. In fact, I alerted that in our Discord channel. I was able to make like I think 11%, but stocks like BJ, they were really set up to go perfect, breakout mode. They just did nothing. I mean, just stayed there, even actually closed lower for a day. So it was actually more like those FOMO stocks, the beaten down NASDAQ stocks that have been decimated throughout the year. They were the one that actually rallied. So not a lot of proper setups for breaking out. So that's why I still have it on not working. And as far as long, mid, and short term, long term, definitely negative. Mid term sort of switched to neutral, and the short term definitely positive. As I said, indices rallied, stocks not so much, but nevertheless, that follow through day that we had on the S&P 500 and the NASDAQ definitely puts the short term market on positive. So now let's look at the price action. And I'll explain what I mean by more caution than more buying. So market price action comes next. And just as usual, we start with my three index layout. This is the S&P 500, the QQQ, the NASDAQ, and IWM. I don't look that much at the Dow Jones Industrial, although I'll show you a chart of it as well. I just want to make a remark there. So speaking of the S&P 500, let's maximize this. And the first thing that you will notice are those lines. I'll show you just in a second a cleanup chart to see where those lines are coming from. What I want to show you here are a couple of things. The first one is the net highs, net lows. We were able to close actually on positive. That was on Thursday. On Friday, we had 24 on Thursday and 47. On Friday, so the net highs were more than the net lows, so that is a positive change right here. And let me just switch to NASDAQ and then IWM, and then I'll show you cleanup charts of S&P 500 and Dow Jones Industrials. I wanna show you something that is really important. What's going on right now? NASDAQ, although it rallied, and you can definitely see here, it moved through this resistance zone, and now it's heading into 291, which is my next major resistance zone. It's still closed at minus 34, net new highs, net new lows. So although it's rallying and it's past the 50-day moving average, there were huge volume on Thursday and on Friday. It's just it's not supported by the net highs, net lows. So we really want to see this going to the positive side for the market to actually do something meaningful in terms of the positive side. And last but not least, right here on the right side, we have IWM. It touched perfectly the upper part of this channel, rejected. Here is the 200-day moving average. So we might see some movement down next week. So having said that, let's take you to another chart that's much cleaned up, and this is the Dow Jones Industrial. Now let's do this one because this is the weekly chart. So I want to show you something. If you draw like normal trend lines, nothing spectacular here, just draw it like that or draw it here, it doesn't really matter. The idea that I want you to get is this, like look at this. This is sort of like the megaphone effect that you are seeing when we have increased volatility, and it is not a positive sign when it's happening at the top of the range. Now this top of the range right here is definitely trying to break out, but if you also do like measured moves, and I don't have it here, let me just do it here, Fibonacci measured moves, yep, the Fibonacci extension. So if you do a measured move, which is absolutely normal, you can see that we are right at 100% right here. So these moves are almost identical now. And we are getting to a point where we might be in a situation we are somewhat overbought right here. So given the fact that if you look at the advanced decline line, and I don't have it here on the chart, but if you look at the advanced decline line for Dow Jones Industrial, you will see that actually advanced decline line is way lower than when it was right here on this peak. So that should tell you enough. I mean, yes, we are rallying in terms of the indexes, but stocks are not really supporting this move. So the indices are rallying, that's for sure. Let's take a look at the SPX because it's a cleaned up chart as well. So the SPX, if you look at the weekly chart, you'll see the exact same thing. I mean, it's rallying, and this is the daily chart. I mean, it is rallying, but what is really important to note here is, and if I get it to the SPY, you'll see what we will see is that we are hitting a zone of collision right here. We have this trend line to the upside coming right here at 415. We also have, let me just draw it right here. We also have this resistance right here. We have resistance from this lower line, and this lower line comes from the COVID low. You can see I've drawn pretty much touches of every low here, here, here. We have one right here, we have one right here. So the yellow ones are the ones that are active right now. So you can see those two resistances along with this resistance right here, which is the 410. And speaking of resistances, I mentioned that I'll tell you something about the options. Now the options profile for next week into OPEX, which is the options expiration, looks like 360 is our support at the bottom side, but 410 is our resistance at the top side. So 410 is pretty much the highest of the range that the options are currently giving for this week. And if we go back, and again, I'll just go to SPX because it's much cleaner, we don't have all the chart. Look what happened, that's the daily chart. Look what happened on Thursday. So we have this action, so we start Monday, then we have Tuesday. And on Tuesday, everything looks good, except for the fact that, you know, this is not really moving. So this is the open, this is the close. So basically it's almost like a doji candle. And then on Wednesday, you have a gap down, so we open right here. We try to move into the closing area of prior day, we don't even get there. And then we reverse. And now everybody here is thinking, all right, we are coming to test these lows, right? 3,700. And everybody's trying to get short. Now, if you look at the volume on Wednesday, the volume on Wednesday was pretty much the same as the volume on Friday. Like, let's go back to SPY because it has volume, SPX does not. So if you look at the volume, on Wednesday, that's a relative volume. All right, just give me a second to add volume average right here. So if you look at the volume here, right here's the Wednesday volume. It's almost the same as on Thursday, on Friday, right? So everybody here is getting short. Now, I know, and I said it in chat, don't try to be directional going into CPI on Thursday morning, because Nevertheless, CPI comes pre-market, and you don't really know what the market's going to do. I mean, it can really get down and, you know, test these lows, undercut them, whatever, but it can actually rally higher, and that's what happens. So everybody, going back to SPX for cleaner chart, so everybody who tried to get short here got majorly screwed on the next day with this gap up. And you can see, I mean, this one did not move like a wick down. There's no wick. This just gapped over or almost identical to the highs of Wednesday and just straight up shot up. So everybody here tried to cover the shorts. And this market, especially in the past few weeks, has been really identified in terms of volatility by the zero day to expiration option. So everybody's trying to play 0-1 day to expiration options, and this creates a lot of volatility in the market. And everybody here got screwed up and had to cover the short. So puts are being closed, calls most probably are being bought. But the important part here is that in order for you to sustain a rally down the road, you need calls that are further out in expiration. You don't need like 0 or 1 day to expiration calls. This creates short-term volatility, but it does not create a lasting rally in the market. So this is what happened. And now we're going to 400, which is our magnet, for next week OPEX, and 410, which in this case is, as I said, in this case is our upper range. So translated to S&P 500, if you don't know, it's just divide this by 10, and then you have 410 for S&P 500, and you have 400 for S&P as a magnet. So basically, they've reached the ranges that we're talking about. And at the same time, you're looking at stocks, and I said BJ is perfect setup, and see what it did on Friday. I mean, it's like incredible reversal. I mean, it opened right here at the close, tried to move higher, and then just selling began. It closed below the Thursday range, below the Wednesday range, below the Tuesday range, and Monday is here. So huge selling volume, nothing happened. On the other side, as I said, DAX, look at DAX. All right, I give it. It had the earnings right here. Look, that's a gap, and that's a move, like 30% move. Crowdsource. Gaps, fills the gaps, moves. That's 135, that's 145, that is $10 on 135 stock, that's 7%. Crazy move, right? So we have things like this. I don't know if Roblox moved higher. Yeah. So we have things like this, these are beating down stocks. I mean, if you look at Roblox on the weekly, I mean, from 141.6 to 36, I mean, that's crazy. Yeah, they're seeing this trend line definitely here on the weekly. They're seeing it. You see, they undercut the lows right here, this range, and now we close back above it. So this might be a long, for all I know, this might be a long. But the fact is that the good setups, the companies with high relative strength, the companies with good fundamentals that were setting up properly are just not picking up. So that's why we have our breakout signal on. Still negative, not working, and that's it. So let's go to the internals, and I'll just switch back to the charts. First things first. Sorry, too many monitors, too many things going on right here. So a couple of things. I'll just do it like this, make it easier. Come on, let's work with me. All right, now working with me. All right, let's do it this way. So what we have right here on top, the purple line, this is the S&P 500. The white line is NASDAQ composite. You can see that the S&P 500 is going above NASDAQ, and that's been since they crossed right here in March 2020. We need to see NASDAQ being above S&P 500 for a good sustained rally to happen. As far as my oscillators, they're touching the upper zones where they meet resistance. Here's the advanced decline issue, and here is the advanced decline volume. As far as the side breadth thrust, it's also going to the 61.5, which is the oversold zone. And McClellan oscillators, same thing, going oversold. And you can actually see that there's some divergence right here between McClellan, the S&P 500, making new highs. McClellan is not. So we might see some divergence going this time around. As far as put call ratio is hanging around 0.9. It was really low, 0.67 on Friday, but the moving average that I use is the 5-day moving average. It's 0.9, so that's like a neutral reading. It's not much. Net highs, net lows, you saw them. First time S&P 500 recently broke through with a positive. NASDAQ, the white line, still staying below. VIX dropped to 22.5, which is some sort of recent support zone. So I'm expecting that it might push a little bit higher here, trying to get back into the mid-range of the Bollinger Bands. And the S&P SPX or S&P 500, whatever, we already discussed that one. I'm not going to spend much time on the up-down volume and the advanced decline issues right here. We already saw the new highs, new lows. But what I really want to show you is this little tool, which are the stocks above the 50-day moving average for the S&P 500. And you can see we're going back. This is June 2020. Here's 2021, and here's the current readings. 2022. This is 2021. I'm sorry, and we can actually go back. I think this is 3 years. So just have to zoom out a little bit. And what I want to show you right here, you can see we're drawing a line. Right now 0.8. Let's just say 0.8. So make this line a little bigger so you can see, and make it, maybe this color will stick out. Yeah, you can see that pretty much every time we go above this zone right here, we had we had an outing. Right here we have an outing. So this sort of looks like we are in an overbought situation. I mean, the highest that this line has ever gone is like 0.98. It that's in June 2020. But then we had it once here in August, and you can see what actually, yeah, that's in August, and you can see what actually happened. I mean, it just, collapsed. And this happened on, this date was the 18th of August. And let's get to S&P SPX again. We're just going to use SPX because it's much easier. 18th of August is right here. When on the other chart, right, when we got right here, this one, I'm going to just draw a rectangle, coincided perfectly with, do another rectangle right here, come on, with this zone. And this will happen. And right here at 430, so 430 for S&P 500, we were looking at that's 90% of the stocks were above their their 50-day moving average. Right now we have 81% of the stocks above their 50-day moving average, and if you look at the index, we are quite lower. I mean, these are like 30 points. But again, as I said, through the entire 2022, although price of S&P has been higher, it's been here, January, we had it right here. So just let's just draw some lines here so I can show you what I mean. It's been here, this will show, and then here, these are all peaks that we've been higher in terms of dates. You can see, and we go back to the stocks about their 50-day moving average, we haven't had that. I mean, the year starts right here, and you have lower lows. The only one that was actually higher than right now is what we have right here in August. You see this high right here, the January high right here, then we had in March, but it's still lower than we have right now. And the price of the index in the index on the same at the same time. It's not showing this. So be careful here. I mean, this looks a lot of like chasing right now. Although we have like up until here 410 is, you know, as I said, for OPEX higher range is right here 410. Be careful. We're going back to the indicators. There's another one that is also interesting. These are the stocks above their 200-day moving average on the S&P 500. And look at where we're now. I mean, this is August. Right here is August when the price when the price of the S&P 500 was at 430, and right now we are at 400. And we have more stocks that are above their 200-day moving average. The index is not supporting that. So it's a little bit of a strange situation right here what we're going on, but I think that we're definitely looking at being a little bit extended right now. And especially given the current prices of the S&P 500, we do have to be careful. The two things are not, you know, speaking the same language right now. So just be careful. Just be careful when you trade. So this is what I have for the internals of the market. It's just a little bit, you know, tricky situation right here, especially with OPEX next week. So just be careful and don't go immediately into buying. But as I told you, the main thing that happened right now is a lot of people just got really screwed on Wednesday with this rally. And since we're getting into the upper range of the target, I don't expect, you know, really amazing moves for this week. I think the volatility will be a little bit tighter when we come to OPEX, and then OPEX will probably unwind some of the options that we already have. Some positionings will have to be changed from the dealers, so we might see some change in direction or a support in the direction that we're already going if dealers are lining up like this. So let's go into my notes, and we will start with actually there are only like three things that I want to talk about really this weekend. The first one is the CPI that came lower than expected. I already showed in the charts. It's showing that inflation, you know, is cooling off, so people immediately decided that this will actually result in lower Fed rate hikes. And you can see that the week prior to the Fed to the CPI numbers, the probabilities were almost even. So the first column is for 50 points, you know, hike. The second column is for 75 points hike. Once the CPI numbers came, this changed to 80-20. So now we have 80% probability of a 50% rate hike and 20% of a 75% rate hike. So this is what happened in terms of the rate hikes and in terms of the CPI numbers. This is what the CPI numbers actually changed. And we know from past experience that as soon as the rate hikes pause or start decreasing in their magnitude, this is the time when the market turns, you know, and start running. So this was what was expected by traders, and they reacted to it. The risk on mode, as we were talking in chat, you know, switched, and probably some of the funds decided to go into higher beta stocks, higher alpha well, not alpha in this case, it's beta. So higher beta stocks that were beaten down in trying to get bigger returns like that, instead of playing it safe with, you know, the stocks that we're watching and they're setting up on high relative strength. The other thing that is important to understand is that as Paul already said, you know, they're not going to change the policy based on data from a month. They need consecutive months of improvement in order to start relieving the hikes. And on another page, the ECB, the European Central Bank, are not talking about relieving you know, rate hikes right now. They actually started really late. So probably we're going to see rate hikes in Europe for the entirety of next year. And I don't think that this data right now is, you know, suggested that, you know, the Fed will change the policy overnight. They said, well, actually Powell said that they are going to be reviewing some changes in the policy, maybe in their meeting in December or January, but that's not going to happen. That's not going to happen overnight. And remember, since the Feds do want to create some sort of recession or at least slow down the economy a little bit, a hot market is not what they want. So they're going to make everything possible to lower the market, or at least keep it, for now in some boundaries instead of letting it run hot, because this will create more wealth, and this is literally what the Fed don't want to do. The other thing that shook actually the financial market is the FTX saga. You probably, if you're following crypto, you're probably familiar with this. The FTX saga is SBF's Sam Bankman-Fried. Basically, his crypto exchange FTX, I think, was the second biggest. It just collapsed on some internal dealings with their daughter company, whatever you want to call it. You can read all about it in our Discord server. There are a lot of publications about it, how this whole thing happened. But this is, I guess, just another reason for regulators to step into the crypto market and at least try to regulate the exchanges to a point where these things cannot happen, basically printing money out of thin air. Binance said that they could try to save FTX, of course, pending seeing all the information and documentation and the financials. And once they saw it, they said it's just beyond their capabilities to actually step in. So FTX had to file for Chapter 11 on Friday, and this shook down the already shaken crypto market. But actually, to my surprise, it's holding better than I expected after such a thing. I mean, this year has been the year of collapses, so I was expecting to I don't know, like Bitcoin hit, I don't know, $8,000 or whatever. It did not. So it's actually okay for what was experienced, for the billions that were wiped out of like the second biggest exchange. I think the market actually handled it amazingly well. So nevertheless, this is just another red dot into the crypto industry, seriously undermining the sentiment. And you will see right here in the sentiment we're talking about, it's on extreme fear, but seriously undermining the credibility of the crypto sector for now. And it's up to the likes of Coinbase, Binance, and really strong tokens to prove that crypto is trying to change its nature from being this it's like Ponzi scheme type of investment for now, because honestly, this is what it's turning out to be, as for now, at least for now. So turning out to sentiment, the CNN Fear and Greed Index is on greed. 1 month ago we were at extreme fear, and you can see how sentiment is just bouncing around. Even the FTX saga could not put a dent into their index. I removed the American Association of Individual Investors for this week just because, as you've seen already, they're 1 week down. And it's just a very lagging indicator. This week I saw it was bullish. Actually it was bearish because prior week was bad, and it will turn extreme bullishness next week when we have it, but this will already be past like 1 week data. So I don't see the reason why I need to show that to you. And as I said, the FTX saga, Bitcoin, now we have it on extreme fear. We were almost here at the neutral last week. But this definitely created a problem. You can see this bear flagging thing, Bitcoin just broke below it. But so far so good. I think it's holding up pretty well for what actually happened. I think it has really serious implications, but I also think that this is the time that crypto might actually find a bottom, because regulators would probably need to step up right now and create better governance, especially for exchanges. So that they can keep the technology running and developing and turning into something really beneficial for people. As far as seasonality, I'm just repeating the slides that we've already been repeating. Not at the end of October, but first couple of weeks of October, we were expecting for the NASDAQ cycle work from Ned Davis Research, showing an uptick in NASDAQ. This did happen to some extent, and as far as Dow Jones Industrial, October or September, October-ish, right here was supposed to be the end of the bearishness for for Dow Jones Industrial. And right now, I think that you can say that we're right here, at the end, we're right here. So another leg higher, there's some consolidation, and then a real breakout in the third presidential year. The second presidential year is usually the worst for stocks, and combining this with the war between Russia and Ukraine, the energy crisis, the mounting CPI data, this second year definitely lived up to the expectations of being, the worst in the presidential cycle. And now, as far as the summary go, the models, I said buy caution, but more stress on the word caution than on the word buy. The setups neutral. I'll have another video with some setups that I'm watching. They're not a lot. The market's positive on short term with this follow through days that happen on NASDAQ and S&P 500. The put volume is neutral, 0.9 put call ratio. I told you. Volatility is decreasing, definitely. VIX coming down to 22.5. And of course, recession and the Fed hikes are still, the main topic, along with the FTX and the war between Russia and Ukraine. And just be careful. Just be careful. Be extra selective in your setups, and either trade smaller size or you trade tighter stops. There's no other way around it. So you have to make your own choice. This is for me for now. If you have any questions, please post them up right here on YouTube or join our Discord server, where actually you will find amazing traders, amazing community of people that are trading minded, and they'll help you out a lot with your trading. If you're struggling or you have some things that you want to talk about, just come and hang out with us, guys. So I'll see you next week. Until then, stay safe, trade smart, and take care. Bye bye.